Okay, we are going to talk about risk today, and we're going to talk about how no one can determine risks except for you. You are the only person that can figure out if a trade is too risky for you or it doesn't take on enough risk to be profitable enough for you. Okay, so there are a lot of people who will just say, don't trade options, there's too much risk, but they don't even understand what the risks are and they can't explain any options theory to you at all. And there are other traders who just want to take on super risky trades because they feel like options trading is just like the cherry on top and it's a little bit of gambling and maybe they can do really well with it. Okay, I'm not going to say any of those things are right or wrong. That's not what I'm here to say. What I am here to say is that you need to determine for yourself what the right level of risk is for you, and you need to know how to assess that risk, okay? So risk is basically about the reward at the end of the day. You have to be naturally prone towards accepting risk to be an options trader, and options traders leverage risks to reap rewards. That's what we do. Great options traders figure out what amount of risk they are comfortable with, and as a trade moves along, they continue to monitor the risk. Okay, so they continue to manage that trade. Risk in options is all about the amount of capital at risk and whether the reward is worth the risk. Okay, no one else can define what is risky but you. Okay, so let's discuss an example of two options trades that will illustrate this point for you. And this is the brain exercise, so get your thinking cap on. We are going to compare a covered call with a leaps contract. So if you do not know what those two things are, this video may not be for you, but I'm wondering, hey, if you don't know anything about options, maybe you can hang in there and this will explain it really well to you too. We'll have to see what feedback is. Okay, so let's consider an Amazon covered call versus an Amazon leaps. Today is May 28th, 2025. These are real options plays that you could do today. So which trade has more risk here? If we bought 100 shares of Amazon for $205.69 per share to sell the 207.50 strike on a 3-week call, we could get $440 in premium, okay? Or is this trade a better idea? Or does it have more or less risk? Buying a leaps contract on Amazon that expires in 380 days for $3,035 and has a 60 delta. Which one is better? Which one has more or less risk? Okay, this is not an easy question to answer. You guys might have had a gut reaction to this, and it was based on certain preferences that you have, that you naturally know that you have, okay? Or it could be based on the fact that you haven't thought it fully through either. So let's go through what I have considered with this, okay? So the first thing I'm gonna do to assess risk is I'm going to consider the capital that is at risk in the play and the income that I can make from it, okay? So when I buy the 100 shares of Amazon for $205.69 a share to sell the 207.50 strike price on a 3-week call to get $440 in premium, the capital at risk is $20,569 because I have to buy 100 shares at 205.69 to place the covered call. I immediately make $440 in taxable income, which reduces my cost on the shares, which is pretty cool. I'm also going to get taxed, 20%, 30% on that $440, okay? So I'm creating a taxable event. And I'm also thinking to myself, I don't really feel like 20K is at risk here because let's assume we're bullish on Amazon. And I just don't think that Amazon can lose 50% in value. So maybe I really only think that I have 10K at risk. See how I did that? So I'm like, okay, well, if Amazon went down 50%, I'd probably have 10K at risk. That's probably the worst case scenario. I think that's fairly logical. I know those are pretty safe assumptions. In my opinion, that's just my opinion, okay? Buying a leaps contract, however, on Amazon that expires in 380 days for $3,035, the cost is $3,035. And we don't immediately make more income. We have $3,035 at risk, and this is less than $20,569. So as far as the capital at risk, clearly the leaps wins here, right? Because it doesn't cost as much money. We just don't have as much money in the market for it to go away and disappear. Like, let's say there's black swan event and everything goes to zero, which is so unlikely to happen. But I guess we have to entertain that as an option, right? So we have less money at risk with the Amazon play, okay? All right. All right, so let's do that. We'll move on. We also made more money, though. We've made money already. We've created a taxable event that the IRS will tax us for on the Amazon cover call. The Leaps hasn't made us anything yet. Okay, let's just assume for this example that the shares haven't gone anywhere for this first page. Okay, so we've considered that. We're all squared away there, all right? Now we got to consider another angle on this. Like, what happens when the shares rise? So when we buy 100 shares of Amazon, okay, and then we sell the cover call, we get to keep the 440 in premium always and forever, okay? If the shares go up in value and cross the strike price, we'll get paid another 181 on cap gains, because the difference between the 207 strike price and the 205.69 is 181. And that's a nice payday. We got 440 plus 181. You guys do the math. It's, that's close to $600, right? So on the other hand, if the stock soars to 220, we don't get the cap gains between 205, 207.50 and 220. So we capped our upside on this covered call, okay? So that's just where we are with that. Those are the facts. Make them negative, make them positive. I don't care. I just want you to consider the risks and the rewards, okay? Buying a Leaps contract on Amazon, however, that expires in that 380 days and has a 60 delta. If the stock goes up, we get 60 cents on the dollar. And if the stock goes up to 220, we pocket about $858 with that delta where we're getting 60 cents on the dollar. And this was way better than owning those shares. Where we could have just owned them for 205 and like had them go up to 220. Okay. So like, and you're going, wait, no, you could have made more having the shares. I'm like, I know I could have, but I didn't have here $20,000 of capital at risk. I only had $3,000 of capital at risk. So my 3,000 made me $858. You see how that's way better? It's just way better. So the same movement up in the shares gets me a bigger reward with less money invested. So we get an insane upside on a smaller amount of money, which is pretty cool. Okay. So when the shares rise really fast, it looks like the Leap is winning, in my opinion. Okay. Consider what happens when the shares decline by 5 to 10%. Okay. So on the covered call side, we get to keep the 440 in premium, and the option expires worthless on our covered call, and we get to keep our shares. We get to sell another call on these shares. We probably won't make as much on the second call because the stock prices decline, but maybe we can bring in another $250, and that's great. Like, there's nothing wrong with that. That's kind of perfect. On the Leaps contract, it's going to expire, and the Leaps decline with a higher percentage than the shares would, so we're feeling some pain on holding this, but we have a lot of time still left to turn this around if we're at least like 100 days out from expiration. We could also make this Leaps into a diagonal spread for income and make this into a backup trade. So I don't know, guys, what's winning here? Really hard to say. Also, it's hard to say which one's going to do better. Like, we don't know. And like, there doesn't seem to be, to me, a whole lot more risk or less risk in either one of these at this point in time. Okay. Now, let's consider what happens if the shares decline more like a 10 to 20% during a market correction, because that's a different ball of wax. So a 5 to 10% move, a 5% move is kind of just normal stock movement, right? 10 to 20% happens when there's a pullback. In the tech industry, it tends to pull back 10 to 20%, usually about 20 with a healthy pullback. So what are we going to do on our Amazon cover call? We're going to keep our 440 in premium. That option is definitely going to expire worthless. We get to keep our shares. Then we get to sell another call on these shares, but if we're still going with the same 207 strike price or at least 205, we might only get like $25 for like a month call. Some money is better than no money, but we're waiting for the stock to retrace at this point. And we also have to consider that we own the stock forever. So if this pullback lasts like 4 months, it doesn't really affect us too much. Like, it's boring, it's frustrating, right? That but the whole market's doing it and you're sort of like, this is okay. I own these shares forever. I still believe in the bullish momentum of Amazon when the market comes back. So I'm not overly concerned with this market correction. If you have your Leaps contract go down for 3-4 months at a time, you're getting more concerned because 3-4 months taken out of a 380-day leaps is a huge chunk of theta that's just like diminishing by the day. And your leaps is probably worth around about half what you paid for it if this happens in the first 3 months, 6 months, even more dramatic if it's nearing the end of the contract. So you just have a limited amount of time for this stock to turn around. And if it was sort of like a year like 2022, where it happens at the beginning of the year and that stock doesn't retrace till well into the next year, you're kind of SOL, right? You can sell this option at any point in time, but you'd be selling for a steep loss. Okay, so that's what's happening there. So you got to determine here, right? On a 10-20% pullback, what has more risk? Which profile do I like more? Okay, I don't know. It's up to you. All right, and then we got to consider time. Time would be another thing that we have to determine as part of our risk. So with the shares that we own for the covered call, we have no time limit. We can choose to own these shares forever, and we don't have to sell calls on them if we like, but we can. So we can also just keep them. We could like sell covered calls on them and then just like not sell covered calls on them when they retrace and just see if like we can even make a cap gain and hold them for 5 years. We could do something like that. With buying a leaps contract on Amazon, we have about 300 days to make a profit, or we get too close to the expiration date to actually turn a profit. So there is a point in time where if the stock hasn't gone up in value or the stock went down, that it's almost impossible to catch up with if the stock retraces, to catch up with that downward momentum the leaps experienced at any point in the contract and have it recover to the $3,000 that you spent. Okay, theta is constantly eating away at our contract's value if the stock doesn't move up. Okay, but here's where it gets interesting. On the other hand, if the stock rises, we get 60% of the rise in the stock over that time period for such a small initial investment. So I have some leaps on Palantir and HIMS and stuff like that. And what comes to mind on that is just that those stocks started soaring as soon as I bought my leaps. I have like 2 years left on my leaps and they already have something like a 250% profit on it. And I'm just like, hey, maybe we can get these to 500%. So it's really hard during that period of time to get a 500% return on shares. That wouldn't be what would happen. Your leaps would generate more of a profit there. Okay, so considering what exiting the trade looks like, that's another thing that you would have to do if you're going to determine which of these trades is more risky, okay? Buying 100 shares on Amazon, okay? Once we sell the covered call, if the stock goes up, it's very expensive to buy that option back. And I hate it when people do that, so please don't, okay? That's my personal opinion. If the stock goes down, we can buy the option back and make a profit on the overall contract because maybe we sold it for $440, but we can close out for $40, so we still make $400. Or we can let it expire worthless and take the whole $440. We have a time limit on this option. It's going to be 3 weeks, okay? There's a slight chance if the shares go up past the 207 that will be called out earlier on it, but we probably realistically are considering our time limit to be at 3 weeks. We cannot use a stop loss on these shares. You cannot put a stop loss on a shares at the same time that you have a covered call. You have to buy your call back first and then sell the shares if you wanted to sell them for a loss if the stock declined quickly in value, okay? With a leaps contract, we can sell at any time. So exiting the trade is super easy, whether we're exiting for a profit or a loss, okay? We don't have to sell a contract first to then sell it, okay? Like we do with a call. We can also place a stop limit on our leaps to sell us out at like a 10% loss so that we never have to take a steep loss. This is sort of what day traders do. They'll buy leaps or calls and they'll put a stop loss on it immediately so they know they're never going to lose more than 10%. Maybe they make it 5%. It's kind of up to you what you want to do here. But with the leaps contract, it has the ability to put a stop loss on it. It also has the ability to put on a sell order to exit when the stock moves up to an upside that you like. So you could say, hey, I want to sell this at a $500 profit, plug that into your software and it'll just do it. It'll do it overnight too. So it's kind of interesting how these differ, right? Like one has more ease of getting in and out and it's the leaps. The covered call, you're kind of more locked in. It's more of you have a contractual obligation to someone. On the buy side of the leaps, you own the contract and you get to determine when to enter and exit it. So interesting, right? The last thing that I'm really concerned about is I want to consider if the trade itself has backup trades. Okay, and I never enter trade unless it does have a backup trade. Now, the backup trade to the covered call is simply more covered calls. Okay, so if the stock drops, which is kind of like what I don't want it to do when I have a covered call, I want it to rise, which is kind of the opposite of what everyone would say on YouTube, but I'm looking for income. If you're looking for something else, then, and you want share appreciation, that's fine too. I'm just sharing kind of how I would view this. So if we don't get our shares called away, we can sell more covered calls and we can change our strategy on the second and third covered calls we sell to get different outcomes. So we could start selling a 50 delta on the covered call, and then like it could expire, and then we could go, hey, next time I'm just going to sell 30 delta because we're approaching a time going into Amazon earnings, and I think those shares will rise. So we could also just decide that we want to keep the shares for a long-term hold. So those are the backup trades with the covered call. Okay. With a leaps contract, oh, this is where it gets interesting, because you all just maybe thought, oh, we're just stuck with this leaps. It's going to go up or it's going to go down, and it's going to do it on a scale that's more dramatic than owning shares. True. However, you can also sell calls on a leaps and turn the leaps into a cash cow machine. Okay. So the plot thickens. We could potentially sell calls though too aggressively and get stuck where we need to buy the call back to sell our leaps, and then we get stuck up against a background on our leaps. So some of you people who have traded diagonals would say that you've painted yourself into a corner. Okay, that can happen. So you can see now like how this is not an easy question to answer. Okay, this is not an easy question to answer. Which of these trades is better or worse from a risk perspective? They each have their own set of risks, and those risks are actually pretty clearly defined. So as long as you have an education and options, you should be able to figure out which one would be better or worse for your account, right? Okay, if you guys are sitting here going like, I've gotten myself painted into a corner, give me a call. I can help with this. I have backup trades for this, okay? So I don't find this leaps contract to be risky to me, because in my Millionaire Mentorship Program, I have a way of teaching a backup trade on this that takes this amount of risk out of it. All right, so that's pretty cool. So you see what I mean? Everything depends, the risk profile, everything depends on which upside, downside, and capital investment is more appealing to you. That's why you can never just listen to anyone else when they say, oh, that kind of trade is risky. It's like, risky compared to what? Risky compared to what other alternative? Not trading at all? Well, if you don't trade at all and you just have money in your savings account, I mean, I don't like that, because I know I can easily make something like at least a 25% return a year, and you're just sitting in cash, and I'm going, that's stupid. Okay. Anyway, so no one can determine your level of risk and if it's right for you or not. The debate in your mind is probably going to be determined by your account size, the other options you own and trade, and what you need more or less exposure to in your account. That's why education is so key, right? Knowing the ins and outs of every trade helps you determine which trade is best for your account in and out every day. Because I'm placing trades every day. So every day I'm able to look at my account and kind of go like, I like this one today. I didn't like it yesterday. And that's how you get to be really good at trading options. So like, what's my take here on the comparison? The answer may or may not surprise you. I believe that having both trades in the account simultaneously is where the magic happens, or at least having the ability to do both. I won't say I always have them both going on at the same time. That's not true. I always have leaps and I always have calls, but they might not be on the same asset. They might not be on the same underlying. Okay. Then I can get the benefit of both strategies. So my take is that the more you know about options, the more that you can add trades into your account that you are comfortable with the risk profile for, and take out the trades from your system that you don't like the risk profile for. And that is what I've done in my Millionaire Mentorship Program, is that I teach and mentor 7 trades that have variations on each and backup trades on each. that I like the risk profile for, and I like the reward profile for. I spent 3 years researching options and going to all sorts of trading seminars and things like that to actually learn trades that then I decided I don't like the risk profile at all and just threw the trade out of my system, okay? So I also believe that risk management, once the trades are on, is where the winner takes all and the losers go home empty-handed. Okay, so once you put the trade on, that does not, taking on trades is one thing. Managing them through to fruition and their endpoint is another. So I believe that you have to know how to manage these trades to really get the rewards at the end of the day. All right. So that wraps up our presentation for today. This was a fun one. I'm going to do more on risk in the future, but as you can see, nobody can determine what risk profile is right for you. If you want my help options trading, there will be a link in the description where you can make a appointment to discuss what your options are to options trade with me. And if you want to see how one of my clients, Ansel, is doing really well with options and making $14K a month off of his $250K portfolio, there is a link there. He really mastered how to do the risk reward in just 3 months of working with me. He did have an education in options prior where he was making $5K a month. We cleaned up his act and got him into making $14K with the same portfolio size. All right, guys, see you around.